Hello, greetings, welcome to Dividend Blasters. This is our 109th video, and our topic today is invest like a legend. Invest like Stanley Druckenmiller. And while you do, get a quality monthly distribution with DRKY. DRKY is a new covered call ETF. It is launching tomorrow, Wednesday, October 8th. It is being issued by VistaShares. If you've listened to some of my videos, you know that I've covered VistaShares before. I actually own a few of their ETFs, and I'm pretty happy with them. A couple of their covered call ETFs, a couple of their more growth-oriented ETFs. So this is the newest addition to their Target 15 covered call ETF family. Let's get into it a little bit. I want to talk about DRKY. First, a little housekeeping. What I say is not financial advice. This video is for information and education. It reflects my opinions, research, and experience as an independent investor for more than 30 years. So do your own research and due diligence before making any investment decisions. So DRKY, formerly known as the Target 15 DRUKMacro, Target 15 DRUKMacro Distribution ETF. And this is by VistaShares. So what are you getting with DRKY? You're going to get the same thing that you get with OMA and ACKY. Those are two others within the Target 15 covered call ETF family. You're going to get full replication of the holdings, and in this case, it's Stan Druckenmiller's holdings with the Duquesne family office. And we know his holdings. He essentially is an institutional investor. He has more than $100 million in assets. And if you do, you are required to submit a quarterly 13F to the SEC. So that's all publicly available information. So you're going to get that full replication technique. You're going to get that exposure to what he's investing in. You're also going to get a target of 15% distribution annually with this ETF. It'll be a monthly distribution, so approximately 1.25%. Some months it may be a little above, some months it may be a little below, but on average, it's going to come to about 15%. They're doing this successfully with OMA. They also just launched another covered call ETF last month, ACKY, where they're basically replicating Bill Ackman's Pershing Square holdings. So I got some of those too. I have more in OMA because I've been watching it a little bit longer. But I have a good feeling. I have a trust with VistaShares. What I like about them is this. And just before I get more into the Stanley Druckenmiller story and do a deeper dive into VistaShares, VistaShares, in my judgment, does a really good job with their options overlay strategy. It is a responsible and prudent strategy. What I like is that they are very strategic on how they sell their options. They have to sell options in order to get that 15% distribution. They have a professional options management team with years of experience. And so they're mostly selling covered calls. They sell them most likely out of the money to keep you available to getting upside. They will sell some of them closer to the money, at the money, to optimize some of that premium income. But they do it in a very strategic fashion. And what they do is they will earn enough premiums or more to cover the distributions. They are not over distributing. There is no evidence of NAV erosion. And if you've listened to my videos, you know that I do not like NAV erosion. And I see a lot of covered call ETFs out there that, frankly, are not very good. This is one of the many exceptions. And there are a lot of good ones, but a lot of them are not good. This is a good one. These guys are responsible. They're also successful in generating sufficient options premiums and they do not over distribute. So they maintain the net asset value of the fund, which is so important because you don't want NAV erosion. All right, that's the thumbnail on VistaShares and DRKY. We're going to do a little deeper dive, but I think it's appropriate to talk about Stanley Druckenmiller. This guy is a legend. You got like the Warren Buffetts of the world, you have the Bill Ackmans of the world, you have the Stanley Druckenmillers of the world. And what's the common thread? VistaShares issues covered call ETFs that replicate the holdings of those three legends. This one, Druckenmiller, is launching tomorrow, DRKY. A little bit of background on his investment career. I believe when he was 28 years old, he founded and became the CEO of Duquesne Capital. And he managed that firm. He led it from 1981 to 2010. He sort of retired from that. And in 2010, he transitioned really to the Duquesne family office and has been leading that since 2010 and still does. What's the difference? From 81 to 2010, he was managing other people's money. And in the investment world, that can be very stressful, especially when you are as successful as he was. Let me say this, and I'm going to say it twice. From 1981 to 2010, that's about 30 years, he averaged 30% average annual return. I'm going to say that again. From 1981 to 2010, he averaged about 30% average annual return. That is insane. That defies logic. That absolutely puts other fund managers to shame. It's about 3 times what the average fund manager does. I guess he thought, hey, listen, this is enough. This is a lot of pressure. I've proven myself. I want to semi-retire. He had a fund, I want to say it was probably close to $20 billion. He started with, I think, maybe with 10 million. Basically returned all of the holdings to the investors, kept his own holdings, and shuttered Duquesne Capital and decided to do something more for himself, and I can't blame him. And he transitioned to Duquesne Family Office, and these are his holdings. He does not accept funds to invest for other people anymore. He does this for himself. So anyway, that's just a little bit of background. That 30% for 30 years, each and every year, is absolutely it's logic defying. So I wanted to just share that with you. There's a little bit of biography. You can read this about him. And I'm not going to read this. You can pause this and look at this. But just at a high level, he was born in Pittsburgh in 1953. He's 72 years old. He spent his entire career in investments. He actually, after graduating from Bowdoin College, went to University of Michigan to get a PhD in economics. Didn't complete it. Figured it was a waste of time. And made a very smart move to go right into investments. And his net worth today is about $7.8 billion. The assets under management for the Duquesne family office are about almost 4.1 billion. So there you go. This is a very successful. He's a billionaire. You can read about his career and what he did before starting Duquesne Capital. So here's a little bit more of the detail. I mentioned the 30% on average annual return for 30 years. He started with 10 million in 1981. After distributing, or after reaching about, I guess it was about 16 billion. I thought it was closer to 20. He returned all of the investments to his clients, kept his own money, 2.7 billion. I want to say he put about $1 billion into the Duquesne family office, which is just his own investments. It's around almost 4.1 billion. And just for context, and I said this, but I need to say this again. That average annual return for 30 years, 30% is just unbelievable. The average for an institutional investor for that time period was anywhere between 10 and 12%. And if you look at since 2010, it's actually come down. It's a little bit less than 10, it's around 9. So that's absolutely logic defying. And everything that I'm showing you, I'm getting from his 13F submission that was just submitted August 15th. And the value then, 2 months ago, was almost $4.1 billion. You can do a little deeper dive here if you like. You can see all, I want to say 69 holdings in the Duquesne family office. You can see Natera, Teva Pharmaceuticals, Insmed, Woodward Inc., Taiwan Semiconductor, Philip Morris, Mercado, Libra, Integris, Coupang. So, you can read through these. Some of these are not as well known as others. And then as you go through this, you can see that some of these are very well known, big companies. He's very strategic and very smart in how he invests his money. And I think his record speaks for itself. Let's talk a little bit about DRKY. As I mentioned, this is being launched tomorrow. This is the VistaShares Target 15 DRUKMacro Distribution ETF. Now, this ETF is not affiliated with Stan Druckenmiller or the Duquesne family office. VistaShares is essentially taking publicly disclosed information, they're replicating his holdings, and they are integrating an options overlay strategy on the holdings to deliver a 15% distribution yield to investors in DRKY. Same thing that they're doing with OMA, same thing that they are looking to do with ACI. So that's basically it in a nutshell. And here you can see all of their ETFs. So you can see the Target 15 options income. There's 4 of them. Now, DRKY is the new one. I already mentioned OMA and ACI. QUSA, this really is where they invest in value stocks. And then they have a couple of growth type ETFs. Wild, the Animal Spirits, that's a leveraged ETF where they will deliver 2 times the daily return of their holdings. I do have shares in that, and it's just killing it. Check out my last video. I talked about Wild. And AIS is more of an artificial intelligence pure play. And I do have shares in that as well. But anyway, I'm talking about the RKY, and we are looking at the Target 15 options income. And one thing to remember is this: how are they guaranteeing to get to that target? They are selling options, covered calls, and the strategy is sound. And they've been delivering and doing a decent job. So that's how you do it. Here are the goals. I've already covered this really. The replication technique, they target the 15% annual return with 1.25% monthly. And they're trying to maximize upside capture, which is so important because with many covered call ETFs out there, you don't get that. Instead, you get the opposite. You get NAV erosion. Nobody wants, I mean, I don't want NAV erosion. Some people, maybe they think that's okay, or they're in a different place in life or in their journey, and maybe they just want to maximize income. But personally, I do not want NAV erosion, and I want to get some of that upside because I want my investment to last and to grow. And that really leads to the option strategy. I talked a little bit about this. They sell out of the money covered calls. And so, why do they do that? They want to avail themselves and the investors to upside. They will sell some of them at the money in order to improve some of the income generation, but mostly it's out of the money. It's very strategic. It's very smart, and they don't do all of them. So, they're being sharp about it, and that's really how you have to do that. So, as I mentioned, the ticker symbol will be DRKY, the expense ratio, 95 basis points. So, for every $10,000 you invest, you will pay $95 annually. With these covered call ETFs, you will pay a little bit more on the expense side, but you're paying for an options overlay strategy, and that's expensive because that takes work. This will be trading on the New York Stock Exchange. Already talked a little bit about the fund description. Here are the top 10 holdings. They've already released what is in the fund. Already mentioned Natera, Teva Pharmaceutical. And this is when I was looking at um, Druckenmiller's holdings. This here is VistaShares holdings, and it's going to be the same thing. You can see the percentage spread. So Natera is about 17%, Teva Pharmaceuticals around 9.5%, Insmed Inc. 8.61%, Taiwan Semiconductor 7.21%, Woodward Inc. 7.14%, Integris 5.14%, Coupang 4.58%, Philip Morris, the tobacco company, 4.48%, Coherent Corp, 4.26%, and then Mercado Libre, 4.05%. Those are the top 10 holdings. All right. And here it is. If you don't want to strain your eyes, I blew it up for you. And these holdings are subject to change, and they're basically going to be looking at the 13F submissions of Duquesne Family Office to see what the changes are, any buying and selling of shares. They'll replicate that, but they will all maintain that options overlay strategy that we already talked about. And here's just a comparison here of the other three options overlay or covered call ETFs. OMA, QUSA, and ACKY. OMA's been around the longest. They've been around for, I want to say, 7 months. Or over $500 million, almost 600 million. That is quite a phenomenal growth. QUSA and ACKY, they're a little bit newer, and so they haven't had that same growth. ACKY is really not, it's not really fair because they just launched a month ago, but they're already almost at 32 million. That is a pretty decent growth rate for a month. So can you just imagine if they maintain that, that'll be close to 360 to 400 million in assets under management. And you know what's impressive is that these numbers are, VistaShares is not Vanguard or BlackRock. This is a small company, but they're very innovative and they are very nimble. So I think that these numbers speak for themselves. And here's just a little comparison. You can see the distribution yield. I'd say keep in mind that none of these have been around for a full year. So you're not going to see 15%, but you're going to see that approximately they're layering in about 1.25% every single month. You can see ACKY 1 month so far, 1.24%. QUSA a little bit longer, 4 months longer, about 6.5%. 2 months more than that is OMA. They're almost 9%. So they're really, they're sticking to that target. If you want a consistent monthly distribution that is done in a responsible fashion, I'd say take a look at these, but also take a look at DRKY. I am going to be watching it tomorrow when it launches. And folks, that is it. I am glad you stuck with me. I hope you found this to be informative and enjoyable. If you enjoyed the video, give us a like, share the video with a friend, hit that notification bell so every time we release a video, you know about it. And we would love for you to subscribe to our channel. We are on different platforms. So if you are interested in reading up on more insightful investment content, and we do more than just dividends, we do growth as well as value investments. We are on X, we are on Instagram, we are on Facebook. You can see our QR codes and our handles. And I will just give you a friendly reminder that as an affiliate partner of Seeking Alpha, I can extend to you subscriber discounts for their premium subscription, for their Alpha Picks, and the bundle, which is a little bit of both. Premium, you get great insight and up-to-date analysis and stock and ETF quotes, 7-day free trial, and I want to say $30 discount off the regular subscription price. That 7-day free trial I love because you know what? After 6 days, if you don't like it, cancel it, and there's no obligation. But I think you will like it. Alpha Picks, you will get, I want to say a $50 discount, but you're going to get 2 free picks every month, and the picks are incredible. They kill the S&P 500. I subscribe to both of these, so I'm basically like a bundle subscriber, and I think they're phenomenal. It's a phenomenal online investment resource. You can see the links. Go to the links. You read all about them, or the QR code. It'll take you to the site. And if you're interested, go ahead and subscribe. I cannot recommend them highly enough. All right, and there's another slide on Seeking Alpha. And I already talked about the different platforms I am on. This video was brought to you by Dividend Blasters. Look for the logo on any one of those platforms. Until our next video, have a wonderful day. God bless.